I can put a price on it. I take $5,000 as my price for 2027. It could be higher, could be lower. Then I knock off from that so I know number of ounces times the gold price gives me a number. That's their total value of their production. So gold shares across the board, I believe, based on my calculations, are massively undervalued. And I think that's because they come from a tremendously undervalued situation a year or two ago to a massively undervalued situation now. I think next year they'll be undervalued, and the year after they'll be fairly valued, and then 4 years from now they'll be overvalued, probably. And that's a bit of speculation. It's not investment advice. But my view is because we have the higher gold price, those gold mining companies are going to make more profits than are currently being factored into the price. And I think that will do investors very well.
The silver market is seeing a significant development, yet hardly anyone in the mainstream is taking notice. While investors keep obsessed on tech companies, AI, and Bitcoin, a quiet movement is taking place beneath the surface. Physical silver is steadily drying up, industrial demand is rising, and the paper market is showing considerable strain. Clive Thompson claims that this is the start of a structural reset rather than just another temporary measure. He believes silver is being greatly underrated and mispriced, especially when you compare it to gold, energy, and key minerals. Decades of artificial repression and misleading pricing are finally meeting with real-world shortage. Governments need silver for green energy, electric vehicles, military applications, and modern technologies, but the supply just isn't there to maintain expectations. At the same time, central banks and large institutions are prepping for a world where trust in paper currencies continues to diminish. And while the average retail investor is preoccupied, the sophisticated money is discreetly preparing for what comes next. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets.
If we could talk a little bit about some of the drivers that you believe are driving gold right now.
We've seen a lot more central bank buying in the last few years, and many of the indicators are that some central banks are buying gold and not telling anybody about it. They're doing it covertly. The biggest candidate for that is China, where they have they produce about 20% of the world's gold from their own mines. There's also, and I don't have concrete evidence of this, but there's a lot of people who seem to have done the research and got the evidence. There's also large quantities of 400-ounce bars being exported from Switzerland and the UK to China. And these are not the sort of bars which are used at the Shanghai Stock Exchange, which uses 1 ounce, 3 ounce, 100-ounce bars, and then 1 kilogram bars, and they're not the sort of bars which are used in the jewelry industry. So these are the sort of bars which are used by central banks for storage. So there's the internal production of coming from China's own gold mines, perhaps 20% of it going into their reserves, secret reserves. We've potentially got a lot of bars moving to China, which we don't know where they're going, but they're the type of bars which would be held by central banks. And then the last thing we've got is since 2014, China's official reserves, which is basically treasury bonds and gold and special drawing rights, the official reserves have plateaued. Now, that's odd when China's trade surpluses have ever since continued to climb every year. Their trade surplus has been climbing, their current account surplus has been climbing. So for decades before that, as this trade surplus was climbing, the reserves would go up. It wasn't a one-for-one match, but more surplus trade means more money in the central bank. Suddenly, it seems to have plateaued since 2014, which kind of implies they're still potentially building up the reserves, but they're not reporting it. So why are they not reporting it? Because perhaps it would hack off the Americans to know they're buying gold. So they are buying a little bit gold. That's officially reported numbers, but the numbers that they're buying, whilst they're pushing up gold as a percentage of their reserves on the balance sheet, it's still looking like it's relatively small, but reality, it's probably quite big. And I expect the central banks around the world, which are also building up reserves. I saw an article saying that there's less central banks now reporting their gold purchases than ever before. So implication is there's probably a lot of buying, and that's probably why the gold price has reached an all-time high. And simply speaking, most central banks are insensitive to the price. They don't care. They're not buying with a plan to sell tomorrow to make a profit. They're buying because they want a plan B, which does not involve the dollar.
Yes, I think, Clive, I've seen an article recently as well saying that they did a survey with these central banks. I think 75% of those central banks said that they plan to continue buying gold in the next few years. So that's
Yep,
quite.
exactly. That's on the World Gold Council's website that they surveyed the central banks, and a large percentage of them said they will increase their gold holdings this year and next year. And of
Yes.
course, from what we know, that has been happening. But a lot of the statistics are very, very out of date. There's a huge lag between, I think we can only see it up till June at the moment. So obviously, not for, some banks have got it right up to date, but the official number for when you add up all the central banks is probably only June, because many central banks don't report, or they report with a long lag.
Mm-hmm. So, Clive, if we could talk about sentiment. So, okay, so we know that big players are getting involved with gold. We can also see that normal people in countries like China and Asia are also, or in India, are also getting more interested in gold. Would you agree with the statement that in general, masses in the West are still not that involved with this market?
I believe that up until a few weeks ago, maybe only for a week or two in when gold was peaking, there were net purchases in the ETS. But long and short of it is the number of tons of gold held by the exchange traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers? We don't know. So, we're in terms of the public at large getting involved, we're still a long, long, long way away from it. If you look at it, just a tiny fraction of Nvidia's market cap, or Microsoft's market cap, or Apple's market cap, and so on, if that was to find its way into the gold mining sector, Nvidia's market cap could buy the entire gold mining sector 4 times over if the price was where it is today. So if you can imagine just even a tiny percentage of Nvidia going to the gold mining sector, those shares would go through the roof. And now we've seen a very large rise in gold mining stocks this year, indicating that there is some interest in gold. But I can tell you factually that many banks who say they've been promoting gold don't actually have any gold in their client portfolios yet, or just starting to put it in. I think it will go in 2026. It's a very long and difficult process when you decide to go from zero in an asset allocation to anything above zero for any asset you like. I know that because I've worked in banks all my life, but just so, I mean, people think, oh, it's easy. The bank decides we're going to put 5% in gold and it's done. It doesn't work like that. Let's say the chief investment officer decides that 5% in gold would be a good idea as opposed to 0 or 1% or whatever the number is. There's multiple departments now need to be involved. You need to have the legal and compliance departments involved to make sure that is legal under the rules of the country in which you're operating. You need to look at the types of clients to find out if there are certain types of clients where that would be not allowed. For example, in Europe, if you take Luxembourg insurance policies, there's many of them investing through Switzerland, the Luxembourg insurance rules do not permit the holding of physical gold. So, these are things which legal and compliance have to look at. You made a decision to do it, but they've got to look at it and say, okay, let's take each client. It may be illegal or not allowed for clients in certain countries. Then you've got to look at how are you going to get your exposure to gold? Do we buy the physical metal? Do we hold gold in account? Do we have an ETF? Do we do it through the miners? Do we make a customized instrument, a structured product to do it? Do we go for a hedge fund? There's lots of different ways of getting that exposure. So that has to be examined by a department who looks at all the possible ways of getting exposure to see how it can be done and how they want to do it. And they're looking at things like liquidity. Can we move enough money in size.
Recent market movements due to anticipation of Federal Reserve rate cuts. Silver, on the other hand, is staying in the $50 level after momentarily surpassing $55 earlier this month. The $55 level is now regarded by many analysts as a significant psychological barrier. Silver may start a new wave of robust buying and momentum once it definitely breaks and holds above that level. This confirms exactly what Clive Thompson has been saying. We are not toward the conclusion of this cycle, we are still extremely early. The strength of silver is not arbitrary. It is being propelled by the simultaneous convergence of two strong forces. First, industrial demand is skyrocketing. Silver is crucial for electrification, AI infrastructure, solar panels, electric vehicles, and renewable energy systems. The globe is consuming more silver than ever for technology and energy transformation. Second, investment demand is rising as people worry about growing global debt, currency devaluation, and the slow move away from the US dollar. Clive forecasts that worldwide investment demand for silver might reach more than 200 million ounces in 2025. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
I can put a price on it. I take $5,000 as my price for 2027. It could be higher, could be lower. Then I knock off from that so I know the number of ounces times the gold price gives me a number. That's their total value of their production. Now I knock off from that what's called the all-in sustaining cost, AISC. Now that's a cost which almost every gold mining company on the planet will publish the all-in sustaining cost. It cost us $2,150 to dig it up. We're selling it for $3,500, whatever. You'll have those two numbers for the last year. So the all-in sustaining cost does change depending on the grades they're digging up and depending on how much bigger the mine is or smaller it is, because if you're bigger, you've got more efficiencies and so forth. But broadly speaking, you take the current number, add a little bit for inflation, maybe 10%, and you can get to an all-in sustaining cost per ounce for 2027. So I knock that off. That gives me the gross profit before other expenses. Then we have to deal with other expenses, which is everything else like taxes, like prospecting costs, like marketing, like management, and so on. So you knock off all those other costs, again adjusted according to the changed number of ounces, and you'll get a net profit. Take the net profit, divide it by the number of shares in existence, and you get a net profit per share, or earnings per share as it's known. And then the last step I've got to do is add a multiple. So most companies trade on what's called a certain multiple of their earnings. And that's called a price-earnings ratio. It could be 5 times, 10 times, 15 times, 25 times. Companies like Nvidia and Apple will be trading on more than 30 times their earnings. So that's a bit of a finger in the air, because in one sense, the faster a company is growing, the higher the price-earnings ratio tends to be. But gold mines are special, because the more you take out of the ground, the less there is to dig up. So they don't justify as high. So even if they're growing by 2027, growing very fast because the gold price is up and everything, it doesn't really justify the 30 or 25 times price earnings ratio that you might see on some of the tech stocks. So I tend to think that probably by then the price earnings ratio could be, if it's growing and it's got further prospects out there, probably 10 times. So I take those earnings per share and multiply them by a multiple, which I think is appropriate, typically 10 times, and I get to a price, a future price. Now, I can tell you across the board, I've not yet come across one where the future price ought to be lower than the current price based on those factors. And in many cases, it's many, many multiples of today's price. Now, in some cases, it's 18, 20% higher. And I kind of think it's not really worth the biscuit. Why is it only 18, 20% that you can dig a bit deeper? But in many cases, it's 2, 3, 4 times as high, and sometimes much, much more than that, the present price. So gold shares across the board, I believe, based on my calculations, are massively undervalued. And I think that's because they come from a tremendously undervalued situation a year or two ago to a massively undervalued situation now. I think next year they'll be undervalued, and the year after they'll be fairly valued, and then 4 years from now they'll be overvalued, probably. And that's a bit of speculation. It's not investment advice. But my view is, because we have the higher gold price, those gold mining companies are going to make more profits than are currently being factored into the price. and I think that will do investors very well.
Clive Thompson's message is clear. We are living in an era when most people still don't comprehend how valuable precious metals and especially gold and silver miners could become. The true long-term opportunity can be lying in plain sight while markets chase short-term trends and technology stocks. According to Clive's precise calculations, gold mining businesses are priced much below what they could be worth just a few years from now, especially if gold continues heading toward $5,000 an ounce. The share prices of mining firms may increase far more quickly than the price of gold since they make a lot more money with each increase in the metal. Silver, on the other hand, is suffering a physical supply shortage. The world is using more silver for energy, technology, and infrastructure, while at the same time investors are starting to recognize it as genuine money again. When you consider that there might only be enough silver for 1 ounce per every 44 people, the underlying scarcity becomes impossible to ignore. And if demand grows even slightly beyond projections, it might lead to a significant and sudden swing higher in price. Clive is not making a wild forecast. He is merely adhering to the math, supply, demand, and economic realities of our contemporary world. His method is slow, analytical, and rigorous, and his conclusion is this: we are still early in this cycle. Those that get what is going on today might be the ones who gain the most in the years to come, and the biggest shifts might still be ahead. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.